Who doesn't want money? I want it, you want it, and so does almost everyone else on this planet. And although making money is hard in itself, what is even harder is making it the fair and honest way. This world has seen millions of people take the wrong path in achieving financial supremacy. However, if you scam someone for your own sake, sooner or later, ramifications will indeed come crashing down upon you, no matter how wealthy or cunning you are. This is exactly what happened with one of the biggest Ponzi scams in history, orchestrated by American financier Bernard Lawrence "Bernie" Madoff. Madoff ran the greatest Ponzi scam ever, cheating thousands of investors out of tens of billions of dollars over at least 17 years and maybe longer. In the early 1990s, he chaired the Nasdaq and was a forerunner in electronic trading. And on April 14, 2021, at age 82, he passed away while serving a 150-year sentence for money laundering, securities fraud, and other offenses. But how did Madoff manage to pull all of this off? This is what we are going to discuss today. Also, somewhere in this video is an Easter egg, so be sure to comment when you find it. Now, without further ado, let's begin. Bernie Madoff was born in Brooklyn on April 29, 1938, to parents Ralph and Sylvia Madoff. He came from a modest family, as his father worked as a dedicated plumber before entering the financial industry along with his wife. Together, they founded Gibraltar Securities, a firm that would ultimately be closed by the Securities and Exchange Commission, or the SEC. Before briefly studying law at Brooklyn Law School, Bernie got a bachelor's degree in political science from Hofstra University in 1960. Bernie Madoff founded Bernard L. Madoff Investment Securities LLC in 1960 with his high school girlfriend Ruth, whom he married while he was still in college. At first, Bernie traded penny stocks with the $5,000 he earned installing sprinklers and worked as a lifeguard. He soon persuaded some of his family and friends to invest alongside him. When the Kennedy slide flash crash saw 20% of the market disappear in 1962, Madoff's bet soured, and his father-in-law was forced to bail him out. From that day on, Madoff carried a chip on his shoulder and felt excluded from the Wall Street elite. However, success came when he and his brother Peter began to develop electronic trading capabilities, artificial intelligence in Madoff's words, that drew large order flows and helped the business by offering insights into market behavior. He and 4 other Wall Street heavyweights processed half of the New York Stock Exchange's order flow, much of which he paid for, and by the late 1980s, Madoff was making around $100 million per year. Soon enough, Madoff was appointed Nasdaq chairman in 1990. He served again in 1991 and 1993. However, the good times did not last long for Madoff. At some point, Madoff recruited investors by claiming to achieve huge, consistent returns through a legitimate trading approach. Now we're going to discuss this whole strategy in just a second, but for short, Madoff just placed client assets into a single bank account and utilized it to compensate current clients who wanted to cash out. Now for the explanation. Madoff's ostensibly ultra-high returns entice clients to turn a blind eye to their investments. In actuality, Madoff merely deposited their assets in an account at Chase Manhattan Bank, which merged to form JP Morgan Chase & Co. in 2000, and then sat on them. According to one estimate, the bank may have gained up to $435 million in after-tax profit on such deposits. When clients wanted to redeem their investments, Madoff paid the payouts with new funds, which he drew by cultivating his victims' trust and winning their faith. Madoff also developed a reputation of exclusivity, frequently turning down clients at first. This technique enabled nearly half of Madoff's investors to benefit. The investors were compelled to contribute to a victims fund in order to recompense deceived investors who lost money. Madoff put on a show of respectability and charity, enticing investors with his humanitarian activity. He also conned a number of non-profit organizations, including Elie Wiesel Foundation for Peace and the global women's charity Hadassah. He approached worshippers through his connection with J. Ezra Merkin, an officer at Manhattan's Fifth Avenue Synagogue. According to various sources, Madoff defrauded its members of $2.4 billion. Several factors contributed to Madoff's credibility among investors, including the fact that his primary public portfolio appeared to be made up of safe investments in blue-chip stocks. He also claimed to be employing a collar approach, also referred to as a split strike conversion. A collar is a risk mitigation strategy in which the underlying shares are safeguarded by the purchase of an out-of-the-money put option. Thirdly, the returns of the scheme were strong 10 to 20% per year, constant and not out of the ordinary. As the Wall Street Journal reported in a now famous 1992 interview with Madoff, Madoff insists the returns were really nothing special, given that the Standard & Poor's 500 stock index generated an average annual return of 16.3% between November 1982 and November 1992. I would be surprised if anybody thought that matching the S&P over 10 years was anything outstanding, he says. The SEC had been investigating Madoff and his securities firm on a consistent basis since early 1992, a fact that frustrated many after he was finally prosecuted, as they felt the bulk of the damage could have been prevented if the initial investigations had been more rigorous. In 1999, financial analyst Harry Markopolos calculated that Madoff had to be lying. He filed his first SEC complaint against Madoff in early May of 2000, but the regulator assigned to the case unfortunately ignored him. In a scathing 2005 letter to the Securities and Exchange Commission, or the SEC, Markopolos wrote that Madoff Securities is the world's largest Ponzi scheme. Using what he called mosaic theory, Markopolos noted several irregularities. Firstly, Madoff's firm claimed to be making money, even when the S&P was falling, which made no mathematical sense based on what Madoff claimed he was investing in. However, the biggest red flag of all, in Markopolos' words, was that Madoff Securities was earning undisclosed commissions instead of the standard hedge fund fee, which is 1% of the total plus 20% of the profits. The bottom line, concluded by Markopolos, was that the investors that pony up the money don't know that Bernie Madoff is managing their money. Markopolos also learned Madoff was applying for huge loans from European banks, which seemingly was unnecessary if Madoff's returns were as high as he said. It was not until 2005, shortly after Madoff nearly went bankrupt from a wave of redemptions, that the regulator asked Madoff for documentation on his trading accounts. He made up a 6-page list. The SEC drafted letters to 2 of the firms listed, but didn't send them, and that was that. The SEC was excoriated in 2008 following the revelation of Madoff's fraud and their slow response to act on it. In November 2008, Bernard L. Madoff Investment Securities LLC reported year-to-date returns of 5.6%, during the same period when the S&P 500 dropped 39%. As the selling continued, Madoff became unable to keep up with a cascade of client redemption requests. So on December the 10th, Madoff confessed to his sons Mark and Andy, who worked at their father's firm. They handed him over to the authorities the next day. In 2009, at the age of 71, Madoff finally pled guilty to 11 federal felony counts, including money laundering, securities fraud, wire fraud, perjury, and mail fraud. Madoff continually insisted that he acted alone, although several of his colleagues were eventually sent to prison with him. The so-called Big Four, Carl Shapiro, Jeffrey Pekawa, Stanley Chase, and Norman Levy, attracted attention as long and profitable partners of Bernard L. Madoff Investment Securities, LLC. Madoff's relationships with these men go back to as early as the 1960s, and his scheme lined their pockets with hundreds of millions of dollars each. Several of Madoff's key investors were unable to be tried, however, as they committed suicide in the wake of the scandal's unveiling. Madoff was eventually sentenced to 150 years in prison and forced to forfeit over $170 billion, and his 3 homes and 4 boats were auctioned off by the US Marshals. On February 5, 2020, Madoff's lawyers requested that Madoff be released early from prison, claiming that he was suffering from a rare kidney disease that would kill him in 18 months. However, their attempts failed, and Madoff remained within the confines of Butler Federal Correctional Institution in North Carolina until he died on April 14, 2021. The paper trail of victims' claims displays the complexity and sheer size of Madoff's betrayal of investors. According to documents, Madoff's scam ran for more than 5 decades, beginning in the 1960s. His final account statements, which include millions of pages of fake trades and shady accounting, show that the firm had $47 billion in profit. While Madoff pleaded guilty and was sentenced to spend the rest of his life in prison, thousands of investors lost their life savings, and multiple stories detail the crushing sense of loss that his victims had to endure. Investors victimized by Madoff's cruel scheme have been assisted by Irving Picard, a New York lawyer charged with overseeing the liquidation of Madoff's firm in bankruptcy court. Picard sued those who profited from the Ponzi scheme, and by April 2021, he had recovered nearly $14 billion for the victims. In addition, a Madoff Victim Fund, or MVF, was created in 2013 to help compensate those Madoff defrauded, but the Department of Justice didn't start paying out the roughly $4 billion until late 2017. Richard Breeden, a former SEC chair who oversees the fund, stated that thousands of the claims were from indirect investors, people who put money into funds that Madoff had invested in during a scheme. Since they were not explicitly direct victims, Breeden and his team had to sift through thousands and thousands of claims, only to reject many of them. In a September 2021 update for the Madoff victim fraud, Breeden wrote, "MVF is thrilled to announce a new distribution totaling $568,648,065 to 30,539 victims of the crimes committed at Madoff Securities." With the completion of the latest distribution of funds in September of 2021, approximately $3.8 billion has been distributed to nearly 40,000 of Madoff's victims in both the US and around the world. The Ponzi scheme has become a potent symbol of the culture of greed and dishonesty that, to critics, pervaded Wall Street in the run-up to the financial crisis of 2008. Madoff, the subject of numerous articles, books, movies, and biopic miniseries, was punished, but no other prominent Wall Street figures faced legal ramifications in the wake of the crisis. What could have been a poster child for regulation and a revamp of financial guidelines seems to have gone largely wasted, unfortunately. What do you think? Should the government have used Madoff's schemes more handily to regulate the pervasion of the financial industry? Or do you believe that Madoff was simply one of the bad apples and should be looked at as an anomaly rather than the standard? Be sure to let me know in the comments, and don't forget to like and subscribe for more content just like this. Until next time.